Welcome back to Rich Girl Roundup. As a reminder, we will take listener questions about every month, so I'll put out a call for questions on Instagram. Follow Money with Katie if not already, and we will pick one that feels interesting and widely applicable, and we'll answer it. So as a reminder, I'm not a licensed financial professional, neither is Sam here. This is not financial advice. This is just what would Katie do in your situation. Here is this week's question from Becky.
Hey Katie, I'm Becky calling into Rich Girl Nation from Detroit, Michigan. Can you share more info on how you personally structure your asset allocation? Do you do a simple 3-fund portfolio, or do you also mix in other asset classes like small cap, emerging markets, value indexes, and REITs? If so, what percentages do you use for each? Also, do you prefer to use a super low cost investing company like Vanguard or robo-advisor like Betterment with slightly higher fees? Looking forward to your feedback. Thanks.
I am happy to, Becky. However, this question does force me to admit that I actually am not sure what my overall allocation breakdown is across my entire portfolio. Go figure. The last that I checked was in fall 2021, but as you pointed out, I do have money in a lot of different places. So it was a fairly manual process to assess each account and how much money was allocated towards certain categories across the entire portfolio. So to answer your question about the companies I use, Vanguard, Betterment, M1 Finance, Empower / Mass Mutual, it's my 401k provider, TD Ameritrade, that's my HSA investment provider, and Fundrise. I know that is a smattering, so I will break down why I like and don't like each one. So Vanguard is a tried and true platform. The UX UI is horrible though, so I don't tend to interact with those accounts very often. In fact, I have moved most of my money out of that platform to buy Vanguard funds somewhere else because it was just too difficult to navigate it. It made it too complicated. I do still have a solo 401k there because the more new age firms don't offer those. Betterment would be my robo-advisor pick. I have used Wealthfront in the past and I like them, but Betterment's investing philosophy has a value tilt, which I fundamentally agree with. It basically attempts to buy underpriced segments of the market to increase your returns. And I find that they've done an exceptional job of naming their account types in such a way that they're better for beginners, more intuitive, who may not know how to go about investing for medium-term goals. I'm thinking specifically of their safety net brokerage account for emergency funds and their big purchase brokerage account goal for things like homes. M1 Finance is a newer player on the scene, but I like them because there are no fees and you can build pies, which are basically just asset allocation decisions that you can make up front, and then M1 Finance will invest your cash according to the assignment that you give it. So it's a little more hands-on than something like Betterment because there's no guidance about what level of risk is appropriate for you. But it's less hands-on than Vanguard because you can choose a pre-built portfolio rather than having to pick individual securities yourself. The others I noted were for specialty reasons like Fundrise for real estate or Mass Mutual for a 401k, so I won't spend too much time there. When it comes to my asset allocation, though, I have different allocations set up in different accounts depending on what is available and when I anticipate needing them. Like in my 401k, the options are slimmer, so I invest 90% in a Vanguard target date fund and the other 10% in small cap. That's what's known as the 2 funds for life strategy from Paul Merriman and Chris Peterson, who we have had on the show before. For my Roth IRA, I have it invested in what's considered an ultra aggressive portfolio because it's the account that I plan to use last in my life. So it has theoretically 40 more years to compound from now before it'll be relevant again. So the ultra aggressive breakdown is 34% developed markets, 29% S&P 500, 13% small cap, 9% mid cap, 7% real estate, 7% emerging markets, and 1% international bonds. This portfolio is down about 19% over the last year, which is in keeping with my comment that it is ultra aggressive. For anyone that may not know about those particular ETFs, I'm just going to break that down really quickly. So developed markets would be other countries' economies outside of the United States that are already, well, developed. They're already pretty far along, we'll say. The S&P 500, that one is probably a common one that you've heard before. Small cap, small companies, mid cap, medium-sized companies, both in the US. That is, real estate is, I believe it actually has exposure to domestic and international real estate. Emerging markets are countries that are still developing. The economies are not what we would consider on par with the US and our peer nations. And then international bonds, so other countries' governments. Now, my rollover IRA that contains 3 previous 401ks is invested similarly, but a little bit differently, different percentages here. So we've got 17% small cap, 17% small cap value, 17% total stock market, 17% like Vanguard value ETF. So again, a value focus, 16% real estate, 16% developed markets. So it's more evenly split. That portfolio is down 12% over the last year, probably because it is so small cap and value heavy, both of which have been doing well recently for a change. My taxable brokerage account, which is the account I've been actively funding this year apart from my 401k, is invested slightly more conservatively than the Roth IRA, but not by much. It's 45% total stock market, 20% small cap value, 15% Russell 1000 growth, 5% mid cap, 5% developed markets, 5% real estate. This one is down about 11% over the last year. What you've probably noticed from this breakdown is that I tend to set asset allocations in each account based on the same initial building blocks of hitting all the major categories, but beyond that, I don't really abide by any other overarching strategy. This is partially because I have money in a lot of different places, as I noted, and that makes it tough to maintain an overall target asset allocation. But I also think that it's reflective of how I actually intend to use these accounts and the timelines that they're on. You also probably noticed I don't have much bond exposure. That is partially due to my age and the fact that I'm in the beginning innings of my accumulation phase. So we are actually doing a full deep dive episode all about diversification, why you should diversify, in a few weeks, and we'll break down all of that far, far more in depth. So stay tuned because we will dig into all of it in a lot of detail then.